Assalamualaikum and very good day to our lecturer, Madam Nurirdina, Binti Abdul Aziz and our fellow classmates. First, welcome to our project presentation, postcode FIN533 Personal Financial Planning, and today we will be presenting our project entitled Family Financial Stories, Intergenerational Insight. My name is Nurirdina Alfiera binti Jaimatul Akmal and my group members are Hani, Noorazwana binti Mohamad Jizan, Shahirah Elyana binti Ahmad Zaki dan Sharipah Noorazwana binti Budy Hady. This project was conducted for the personal financial planning course to explore how financial behavior and decision making differ across generations within our family. As we know, financial planning plays an important role in achieving financial stability and improving quality of life. However, financial habits are influenced by factors such as family background, economic condition, education, cultural, and technologies which lead to different across generations. The purpose of this project is to explore and compare financial experiences and behavior among three generations: grandparents, parents, and the current generation. Through our interview, we examine the key areas such as saving habits, spending patterns, budgeting, borrowing behavior, investment preference, and financial challenges. This study also helps us to understand how financial literacy and changing economic environment influence financial decisions over time. Ultimately, it allows us to connect theory with real-life experiences and learn practical financial lessons for our financial well-being. Thank you, and I would like to invite for the next presenter.
I'm really excited to present the key financial stories and insight from our report. Our project looks at something we don't usually talk about at the dinner table, how the way we handle money changes from generation to generation. We focus on three generations within a Malay community family, which is grandparents, parents, and also the young generation, which is the current generation. The big takeaway here is that money management is not just about maths. It deeply shaped by the times we grow up in the economy, the culture, and the technology around us. We are going to look at how financial habit shifted from old school discipline to modern digital convenience and see what lesson we can learn from each other. Let's start with the first generation. Okay, let's talk about generation 1. We have interviewed a 68 years old retired teacher. Today she has a very steady financial life thanks to her monthly pension and some rental income. What's amazing about her story is that she didn't learn about money from Google or even finance class. She learned it out of pure necessity. Back then, with all these fancy banks and apps, her rules were simple. Save as much as you can, focus on what the family actually needs, and avoid debt like the plug. She stuck to safe, traditional choice like normal bank accounts, fixed deposit, and ASB. But don't think she's stuck in the past. See, she's actually adapted really well to modern times and now use online banking and digital payment for her day-to-day stuff. She is the perfect example of real financial discipline. Next is generation 2, the parents. They grew up during a time when Malaysia was developing fast and cities were growing rapidly. This generation was first to really get plugged into the modern banking system. Suddenly, they had access to credit cards, bank loans, insurance, and company pension. Because of this, their financial story is all about balancing the present while securing the future. They had to take care of daily family needs, but they also had to plan, buying property, paying for their kids' education, and saving for their retirement. But having easy access to loans means they also took on a lot more debt. So when they taught us how to build access, they also show us how heavy managing modern debt can be. Now let's look at us, generation 3. For this part, we look at 25 years old human resource with a steady monthly salary. As digital native, money live completely inside our smartphone. We don't just use banks, we also use e-wallet, e-commerce apps, and budgeting tools for almost every single transactions. We have high goals. We want to grow our wealth fast, build emergency funds yearly, and reach financial independence. Plus, we have endless financial info right at our fingertips. But there is a major downside because spending money today is as easy as a single click. We are incredible to impulse buying and lifestyle inflation. When you mix that with high inflation and the rising cost of living, we find that even though we have all the tools and knowledge, actually saving money is a huge mental struggle for our generation. You look at this comparison table, the big picture becomes super clear. Every generation has a financial superpower, but also a specific weakness. For generation 1, it's amazing at pure disciplines and avoiding debt. Their only downside was that they didn't have many investment options back then. For generation 2, mastered long-term planning and buying property, but they end up carrying a lot more debt. For generation 3 has the teach skills and yearly awareness, but we struggle big time when impulse control in the digital world. This shows that managing money is not a one-size-fits-all things. It constantly changes as the world changes.
Assalamualaikum. So I will cover for lesson learned and recommendation. So based on our studies, we found out that each generation demonstrate different financial behaviors influenced by their life experience, responsibilities, and also exposure to technology. For generation 1, the grandparents, the most important lesson learned is the value of financial discipline. They consistently save money, avoid unnecessary debt, and focus on long-term financial security through low-risk investment and careful budgeting. For generation 2, the parents will learn the importance of balancing financial commitments and future planning. They manage household expenses, loan repayments, children's education, and retirement preparation while maintaining stable financial management. For generation 3, the current generation technology plays a significant role in financial management. Although they have easier access to financial information and digital tools, they still face challenges such as rising living costs and lifestyle spending. So overall, this study shows that financial success is not determined by income alone, but by discipline, planning, and the ability to adapt to changing financial environment. Next is the recommendation. Based on the findings, several recommendations can be made to improve financial well-being across generation. For generation 1, it is recommended to strengthen digital financial literacy and cybersecurity awareness to reduce the risk of online scam while continuing effective wealth preservation strategies. For generation 2, a greater emphasis should be placed on retirement planning, investment, diversification, and faster debt repayment to ensure financial freedom before the retirement. For generation 3, building an emergency fund, increasing a long-term investment, and improving financial literacy are essential. Financial technologies should be used not only for transaction, but also for budgeting, expense tracking, and saving management. As a family, knowledge sharing between generations should be encouraged. The younger generation can be financial disciplined from their elders, while older generation can benefit the modern financial tools and technologies. In conclusion, combining traditional financial wisdom with modern financial practice can help family to achieve a long-term financial stability and financial success. I will pass to the next presenter. Thank you.
So I will continue with our group co-reflection. So for generation 1, our grandparents represent a defensive practical survival mindset born out of necessity. They strictly avoid debt and compound with their secure retirement using traditional lowerings like ASP. Next, for generation 2, parents act as a transitional bride driven by the philosophy of uko baju di badan sendiri. They combine a steady salary with a careful liability control, utilizing yearly frontage strictly as utility monitoring tools. So for generation 2, our current generation is a highly digital centric. While we enjoy seamless access to micro investing and global banking, we face severe modern hurdles including inflation and intense consumerist lifestyle pressure that require a higher level of personal restraint. Now, drawing to our conclusions, this study demonstrates that parenting, education, and modern innovations heavily dictate family financial habits. The central takeaway is that financial literacy is not just about having access to digital apps, it is about self-control. To achieve true financial wellness, the younger generation must integrate the defensive discipline of older generation with modern financial platform. In short, combining the traditional wisdom with modern opportunity is the ultimate key to sustainable financial success. So that's all for our group.